The global economy is a complex and interconnected system. Actions taken in one corner of the world can ripple out and have profound effects on others. Today we're going to examine a hypothetical scenario with potentially significant consequences. What happens if China decides to sell off a large portion of its U.S. debt holdings? As the holder of over $1 trillion in U.S. Treasury bonds, China's actions could send shockwaves through the global financial system. We will explore the potential impact on U.S. interest rates, the value of the U.S. dollar, and the stability of global markets. Join me as we unravel the complex economic and geopolitical implications of this scenario. The U.S. Treasury bond market is the bedrock of the global financial system. It is where governments, corporations, and individuals go to borrow and lend money. The interest rates on these bonds are a key benchmark for borrowing costs around the world. If China were to suddenly flood the market with U.S. Treasury bonds, it would disrupt this delicate equilibrium. This influx of bonds would increase supply, potentially leading to a decrease in their price. As bond prices and interest rates have an inverse relationship, a decrease in bond prices would lead to an increase in interest rates. Such a development would have far-reaching consequences for the U.S. economy. Businesses would face higher borrowing costs, potentially curtailing investment and hiring. Consumers would also feel the pinch as mortgage rates and other loan rates would climb. This could dampen consumer spending, further slowing economic growth. The U.S. dollar is the world's reserve currency, playing a critical role in international trade and finance. Its value is influenced by a multitude of factors, including supply and demand dynamics in the currency market. If China were to sell off a significant chunk of its U.S. debt, it would essentially be exchanging U.S. dollars for other currencies, increasing the supply of dollars in the market. This could lead to a depreciation of the U.S. dollar, making imports more expensive for American consumers and businesses. While a weaker dollar could make U.S. exports more competitive, it would also contribute to inflationary pressures. The delicate balance of trade and the potential for rising inflation would pose significant challenges for U.S. policymakers. The global financial system is built on a foundation of confidence and stability. Sudden, unexpected actions by major players can undermine this foundation, leading to uncertainty and volatility. China's decision to unload a large portion of its U.S. debt holdings could trigger a chain reaction in financial markets. Investors might interpret this move as a sign of waning confidence in the U.S. economy or as a signal of escalating geopolitical tensions. Such a perception could lead to a broader sell-off in U.S. assets, impacting stock markets, bond markets, and other financial instruments. Increased market volatility could make it more difficult for businesses to raise capital and could lead to a decline in investor confidence, further complicating economic prospects. The U.S.-China relationship is one of the most consequential bilateral relationships in the world. It is a complex tapestry interwoven with economic, political, and security threads. China's decision to sell off a large portion of its U.S. debt holdings would undoubtedly reverberate through this relationship. It could be interpreted as a hostile act, a sign of deepening distrust, or a move to gain leverage in ongoing disputes. The potential for retaliatory measures from the U.S. side, such as trade restrictions or investment limitations, could escalate tensions further. Such a scenario would create a climate of uncertainty, potentially jeopardizing the intricate economic ties that bind the two nations together. Inflation, the rate at which prices for goods and services rise over time, is a persistent concern for policymakers. It erodes purchasing power, creates uncertainty for businesses, and can destabilize economies. A sudden depreciation of the U.S. dollar, triggered by China's selling of U.S. debt, would exacerbate inflationary pressures. As the dollar weakens, the cost of imported goods rises, feeding into higher consumer prices. This could lead to a wage price spiral, where rising prices lead to demands for higher wages, further fueling inflation. The Federal Reserve, tasked with maintaining price stability, would face difficult choices in navigating this complex economic landscape. The U.S. economy is the largest in the world, and its performance has profound implications for the global economy. A significant shock to the U.S. financial system, such as a large-scale sell-off of U.S. debt by China, would reverberate across the globe. Global trade patterns could be disrupted as a weaker US dollar affects import and export dynamics. Investment flows could be redirected as investors reassess risk and seek safer havens. The interconnectedness of the global financial system means that a shock in one part of the world can quickly spread to others, creating a ripple effect that could destabilize markets and economies far beyond US borders. The Federal Reserve, as the central bank of the United States, plays a crucial role in maintaining economic stability. It has a range of monetary policy tools at its disposal to influence interest rates, credit conditions, and the overall health of the economy. In the event of a major shock to the financial system, such as China's selling off a significant portion of its US debt holdings, the Federal Reserve would likely take swift action to mitigate the negative consequences. It could lower interest rates to stimulate borrowing and investment, inject liquidity into the financial system to ensure smooth functioning of markets, and communicate its policy intentions clearly to reassure investors and stabilize market sentiment. The Federal Reserve's actions would be critical in navigating the turbulent waters of this hypothetical scenario. The global economy is a complex, interconnected system, and actions taken by major players can have far-reaching consequences. The scenario we've explored, while hypothetical, highlights the potential for disruption when major holders of US debt make significant moves. It underscores the importance of carefully managing economic relationships, maintaining confidence in financial markets, and being prepared to respond effectively to unexpected shocks. In a world of increasing uncertainty, understanding these interconnections is crucial for navigating the challenges and opportunities that lie ahead.